You don't need to be rich, you don't need to be an expert, and you definitely don't need to wait. Because the truth is, investing isn't just for Wall Street anymore. It's for you, for your future, and it starts right here, right now. In this video, we're breaking down the real basics of investing, in plain English. No jargon, no hype, just the essential steps to help you build wealth, even if you've never bought a stock in your life. By the end of this, you'll know how to start investing with as little as $10. Avoid beginner mistakes. Understand what stocks, ETFs, and index funds really are, and how to build a portfolio that grows with you. This is Investing 101, powered by Health Wealth Investor. Let's build a future you're proud of. Chapter 1. Why investing matters. And why now is the time. Let's get this straight right from the start. Saving money isn't enough anymore. Inflation chips away at your cash every year. Interest rates in savings accounts can't keep up. So if you're not investing, your money is slowly losing power. But when you invest, you give your money a job. You make it grow. You make it compound. You start building wealth, not just savings. What is investing? At its core, investing is simple. You put your money into something, like stocks, bonds, real estate, and in return, you aim to earn more money over time. It's not gambling. It's not a get-rich-quick scheme. It's the long game, where small, consistent actions lead to big results. Why most people never start. They think they need a lot of money. They're afraid of losing what little they have. They don't know where to begin. But those are myths. You can start with $10. You can start even if you don't know anything about the stock market. What matters is starting. And the cost of waiting. Let's say you invest $100 a month starting at age 25. By age 65, with an average return of 8%, you'll have over $300,000. But if you wait until 35 to start, that number drops to about $140,000. The earlier you start, the harder your money works, because of compound interest. That's the magic of investing. It grows on top of itself, like a snowball rolling downhill. Wealth is built, not born. Most millionaires didn't inherit money. They built it through investing, discipline, and time. You don't need perfect timing. You need time in the market, not timing the market. So don't wait until you know more. Don't wait until you make more. Start now. Start small, but start. Because every dollar you invest is a seed for your future. Chapter 2. What you can invest in, stocks, ETFs, index funds, and more. So what exactly are you investing in? Let's break down the most beginner-friendly options. No confusing jargon, just the real talk. 1. Stocks, equities. When you buy a stock, you're buying a small piece of a company. That's right, a tiny slice of Apple, Nike, or Tesla. Stocks can go up or down in price depending on how the company performs. They can pay dividends, which are small cash payments from company profits. You make money by holding as the value grows, or by selling at a higher price. Stocks are higher risk, but also higher reward. They're the engine of most portfolios. 2. ETFs, exchange-traded funds. Think of an ETF like a basket of investments. It might hold dozens, even hundreds, of stocks, bonds, or other assets. Example, an S&P 500 ETF holds shares of 500 of America's biggest companies. You can buy and sell ETFs like stocks on any trading day. Great for beginners because they offer built-in diversification. With one ETF, you can invest in the whole market, not just one company. 3. Index funds. Index funds are very similar to ETFs. They track a specific index like the S&P 500. They're often a little cheaper in fees. They don't trade throughout the day, only once daily. Often found in retirement accounts like 401ks or IRAs. Index funds are the favorite of financial legends like Warren Buffett. Why? Because they're simple, low cost, and historically consistent. 4. Bonds. Bonds are basically IOUs from governments or companies. You lend them money, they pay you interest over time. Lower risk than stocks. Lower return too. Great for balancing your portfolio. Bonds won't make you rich fast, but they add stability. 5. REITs, real estate investment trusts. Want to invest in property without buying a house? REITs make it possible. REITs let you invest in real estate through the stock market. They often pay out solid dividends. Great for people who want exposure to real estate but don't want to be landlords. 6. Crypto, with caution. Yes, crypto is an investment, but it's still very speculative. Highly volatile, not regulated like stocks. Only invest what you're willing to lose. For most beginners, focus on traditional assets first. You can explore crypto later with a clear risk strategy. So what's best for you? If you're just getting started, look into ETFs or index funds. They're simple, diversified, and low cost. You don't need to pick the perfect stock. You just need to pick something and start. Chapter 3. The tools you need to start investing. Accounts, apps, and platforms made simple. You've got the mindset. You know what you can invest in. Now let's make it real. Let's get you set up. Tool, number 1, a brokerage account. This is your gateway to the investing world. A brokerage account lets you buy stocks, ETFs, bonds, and more. Some of the most popular beginner-friendly brokerages. Fidelity, great for low fees, wide range of investment options. Charles Schwab, strong customer service, good for long-term investors. Robinhood, very easy to use, especially on mobile. Webull or M1 Finance, more advanced options for when you're ready. Want to invest through your retirement account? Then open a Roth IRA or traditional IRA. Many brokerages offer both. And tool number 2, a strategy app, optional but powerful. If you're new, keeping things organized matters. These apps help you track your goals and stick to a plan. Try Personal Capital for tracking your investments, plus Net Worth, Betterment or Wealthfront, robo-advisors that invest for you. Acorns rounds up your spare change and invests it automatically. Tool 3. An emergency fund. Before you go all in on investing, here's one smart move. Build a small safety cushion first. You don't want to sell investments during a crisis. Keep 3 to 6 months of expenses in a high-yield savings account. This gives you breathing room and peace of mind. Tool 4. A system, not just a feeling. The key to long-term investing success isn't excitement, it's consistency. Set up automatic transfers every payday. Even $50 a week makes a difference. Automate your investments, ignore the market noise, and let time do the heavy lifting. With these tools, you're not just dreaming about wealth, you're building it. Chapter 4. How to pick your first investment. Simple steps for real momentum. This is where it gets exciting. You're not just learning anymore, you're doing. You're about to make your first real investment. Step 1. Define your time horizon. How long can you leave this money invested? Short term, under 3 years. Stick with savings accounts or bonds. Medium term, 3 to 10 years. Mix of stocks, bonds, and ETFs. Long term, 10 plus years. You're in wealth building territory. Go heavier on stocks or index funds. The longer your horizon, the more risk you can safely take, because markets recover over time. Step 2. Decide on active versus passive. Active investing. Picking individual stocks, more effort, more risk. Passive investing. Buying index funds or ETFs that track the market, low effort, proven results. For most beginners, passive is the way to go. It's simple, diversified, and it works. Step 3. Pick a starting point. Here are 3 smart starter ideas. 1. S&P 500 ETF, like VOO or SPY, invests in the 500 biggest US companies. 2. Total Market ETF, like VTI, owns a slice of every publicly traded US company. 3. Dividend ETF, like SCHD, focuses on companies that pay reliable cash dividends. These funds are like cruise control. You get broad exposure without having to steer constantly. Step 4. Decide how much to start with. You don't need thousands of dollars. Many brokers now let you buy fractional shares, so you can invest $10, $50, or $100 and still get started. The most important thing isn't how much, it's that you start. Step 5. Hit buy, then hold. This is the moment that changes everything. You're no longer watching from the sidelines, you're in the game. Once you've bought your first investment, commit to holding it. Don't panic if it dips next week. Don't check it every hour. Investing is about time in the market, not timing the market. You just made your first move. Now let's talk about what happens next and how to avoid the biggest rookie mistakes. Chapter 5. Common beginner mistakes and how to avoid them. So you've made your first investment? That's amazing. But now comes the part most people mess up. What happens next? Because here's the truth. Building wealth is more about what you don't do than what you do. Mistake 1. Chasing the hype. Your friend made money on crypto. TikTok says this new penny stock is going to the moon. You feel like you're missing out, so you jump in. Don't. Hype fades, trends pop, bubbles burst. Wealth isn't built in viral moments. It's built in decades of smart, boring decisions. Do this instead. Stick with your plan. Diversify. Avoid emotional investing. Mistake 2. Checking your portfolio. Every day. Watching your portfolio like a hawk leads to fear, doubt, and poor decisions. The market moves up and down. That's normal. That's healthy. When you obsess over every dip, you're more likely to sell at the wrong time. Do this instead. Check in monthly or quarterly. Set and forget. Let time compound for you. Mistake 3. Trying to time the market. Buying low and selling high sounds great. But in practice, almost no one does it consistently. Not even the pros. If you're constantly trying to predict the perfect moment, you'll miss out on the real growth, which happens on the random best days in the market. Do this instead. Stay invested. Use dollar cost averaging. Be consistent, not perfect. Mistake 4. Going all in on one thing. You love Tesla, you believe in Bitcoin. Great, but don't put all your money there. Diversification is your safety net. Even if one investment crashes, others can keep you afloat. Do this instead. Use ETFs or index funds for your core. Then, if you want, add a few individual picks on the side. With money you're okay risking. Mistake 5. Not having a plan. Random investing leads to random results. You need a clear reason behind each move. Ask. What's your goal? What's your time frame? How much can you invest monthly? What will you do if the market drops? Do this instead. Write down your strategy. Keep it simple. Follow it consistently. You don't have to be perfect. You just have to avoid the big mistakes, stay the course, and trust the process. Chapter 6. Building a long-term wealth plan. The strategy that actually works. Let's talk strategy. Because buying your first investment is just the beginning. Now it's time to build a system that grows with you. The wealthiest people in the world don't rely on luck. They rely on a repeatable plan. And so can you. Step 1. Set clear goals. Ask yourself, why am I investing? Retirement? Buying a house? Building financial freedom? Paying for your kids' college? Each goal has a different time frame, and that affects your investment choices. Step 2. Stick to a monthly contribution. Wealth is built by habit, not windfalls. That's why dollar cost averaging is so powerful. Investing a set amount every month, rain or shine. Invest $100 a month for 20 years. Over $50,000, even with modest returns. Automate your contributions so it happens without thinking. This turns investing from a decision into a routine. Step 3. Rebalance. Yearly. As your investments grow, some parts of your portfolio may become overweighted. If your stocks soar and bonds stay flat, you may be taking on more risk than planned. Rebalancing means adjusting your investments to maintain your target mix, e.g., 80% stocks, 20% bonds. This keeps your plan aligned with your risk comfort and time horizon. Step 4. Keep your fees low. Fees quietly destroy your long-term returns. Choose index funds and ETFs with expense ratios under 0.2%. Avoid frequent trading. Most beginner brokerages are free, but hidden costs add up in the long run. Remember, every dollar you don't pay in fees stays in your pocket. Step 5. Think decades, not days. Investing is like planting a tree. You don't dig it up every week to see if it's growing. You nurture it and let time do its work. The people who win at this aren't the ones with the hottest picks. They're the ones who stay in the game longest. With this plan, you've got everything you need to turn investing from a maybe into a lifetime habit. Final chapter. Recap, motivation and call to action. You've just taken the first, and most important, step toward building real wealth. Let's recap what you've learned today. Quick recap. Why investing matters, and why waiting is costly. What you can invest in: stocks, ETFs, index funds, REITs, and more. The tools you need to get started: brokerage accounts, apps, and emergency funds. How to pick your first investment with confidence. What mistakes to avoid so you stay on track. And how to build a long-term strategy that grows with you. You don't need to be perfect. You don't need to be rich. You just need to start and stick with it. Final words of motivation. There's a reason this channel is called Health Wealth Investor, because we believe that wealth is about more than money. It's about mindset, energy, and freedom. When you invest in your future, financially or physically, you're declaring that you believe in the life you're building. Every dollar you invest today is a vote for the person you want to become. Call to action. If this video helped you take that first step, hit like to let us know. Subscribe so you never miss a future lesson, and drop a comment below. What's your first investment going to be? More videos are on the way, from saving strategies to credit card rewards, health habits, and even side hustle ideas. This is your journey. This is your time. And here at Health Wealth Investor, we're walking it with you.